Welcome everybody, we are the Digital Asset Consulting team from Firm 8, and today we're going to discuss with you the current buzz around digital assets, particularly the trending topics and how you can use them to your advantage. If you've been wondering how digital assets are going to affect your tax planning, your questions will be answered today during our presentation. My name is Taya Brita, and I'm joined today by Yi Yang Yi, Bailan Fan, Leping Wen, and Yaya Taleb. We are going to cover an introduction to digital assets, the existing regulations by Congress and the IRS, the reporting for different types of digital assets, and the insights from our professionals into tax planning and future expectations in this area. The information we're going to share with you comes from multiple sources, such as the IRS and AICPA websites, which are listed at the end of our slide deck if you're interested in researching further. According to the IRS, a digital asset can be stored electronically and can be bought, sold, owned, transferred, or traded. Today we are looking at taxes specifically, so it is important to keep in mind that the specific tax definition of a digital asset is any digital representation of value recorded on a cryptographically secured and distributed ledger or similar technology. The key takeaway here is that a digital asset is not considered to be currency, but is instead considered to be property. Here we just have a few examples of some digital assets that you might have seen. So the first is convertible virtual currencies, also known as Bitcoin. The second is a non-fungible token, which you've probably heard of, called an NFT. And the last are stablecoins.
All right, thanks, Taya. So Congress has made legislative developments by passing several bills in recent years, as you can see here in the slides. The acts have brought the cryptocurrency industry into a formalized regulatory environment. But today, what we really want to focus on is the specific taxation guidance issued by the IRS. So the IRS efforts to track digital asset transactions and enhance compliance with tax laws has expanded as taxpayers' involvement in such areas has become more and more trendier. As you can see here, they recently released the final regulations that have higher reporting requirements. Now, brokers are required to file information returns and furnish payee statements, reporting gross proceeds and adjusted basis on dispositions of digital assets affected for their customers in certain sale or exchange transactions. And you now have the same requirements for real estate reporting persons with respect to real estate purchasers who use digital assets to acquire real estate. Then, for our taxpayers, if you are involved in any virtual currency transactions, please keep detailed records that document your transactions. When it comes to filing the tax returns for individual taxpayers, all digital asset filing starts with the digital asset section of Form 1040. So if during the tax year, you receive digital assets as a reward, award, or payments for property or services, or you sold, exchanged, or otherwise disposed of a digital asset, you must check yes here in the box. However, taxpayers should check no if they didn't own any digital assets, or they only held digital assets in a wallet or account without engaging in any transaction throughout the year, or they purchased digital assets using US or other real currency without selling them, even if the purchase were through electronic platforms, or the taxpayers transferred digital assets between wallets or accounts they own or control, unless they paid a transaction fee with digital assets, which would be considered a digital asset transaction.
In this section, we will discuss various scenarios and transactions that constitute taxable events for digital assets. The first one is obtaining digital assets as ordinary income. Taxpayers need to pay ordinary income tax on digital assets received or acquired under the following conditions: receiving digital assets as payments for goods or services provided, engaging in activities that generate income in the form of digital assets, such as mining, staking, airdrops, or hard forks, other activities resulting in digital assets that are considered ordinary income. We calculate taxable income based on the fair market value of the digital assets at the time they are received. Please note that if you obtain the digital assets from mining, staking, airdrops, or hard forks, this income should be reported under other income on Form 1040 Schedule 1. Another point worth noting is that if a taxpayer receives more than $10,000 in digital assets in a single transaction or series of transactions, it must report Form 8300 to IRS within 15 days.
So the second scenario is sale, exchange, or disposition of a digital asset held as a capital asset. If the digital asset is owned for investment purpose, the income would be taxed as a capital gain or loss when you sell or dispose of it. Such digital assets held for 1 year or less are treated as short-term assets, and those held for more than 1 year are treated as long-term assets. You will use Form 8949 for this type of transaction.
The next scenario is inheriting digital assets. Under U.S. federal tax law, when an individual passes away, any digital assets they hold become part of their estate and may be subject to federal estate tax. As of 2024, the federal estate tax exemption is set at $13.61 million. The estate executor must file a federal estate tax return, Form 706, within 9 months of the decedent's death. When calculating the total estate value, digital assets should be appraised at their fair market value at the time of decedent's death. Federal estate tax is applied at progressive rates, reaching a maximum of 40%. The last scenario we're going to discuss today is receiving digital assets as gifts. Digital assets such as cryptocurrency follow the general gift tax rules when given as gifts. In 2024, the gift tax exemption is $17,000, and each taxpayer also has a lifetime exemption of $12,920,000. If the value of the gifted digital assets exceeds the exemption amount, the donor may need to file a federal gift tax return, Form 709. Gift tax rates are also progressive up to a maximum of 40%. When calculating the total value of the digital assets, it should be appraised at its fair market value at the time the recipient receives the gifts. The recipient does not need to pay the tax immediately. However, the tax basis of the recipient is the original cost basis of the donor. Therefore, if the recipient later sells these digital assets, capital gain tax will be calculated on the difference between the sale price and original cost basis.
Two effective strategies for reducing tax liability are holding digital assets for more than a year and tax loss harvesting with digital assets. Let's begin by discussing the impacts of holding period on taxation. The first strategy involves holding digital assets for more than a year to take advantage of preferential tax rate on long-term capital gain, which are 0, 15, or 20%, depending on individual income. On the other hand, short-term capital gain from assets held for 1 year or less are taxed at ordinary tax rate, which can reach as high as 37%. So by holding digital assets for over a year, investor can achieve considerable tax saving when gain taxed at preferential tax rate instead of ordinary tax rate. The second strategy is about tax loss harvesting with digital assets. As explained earlier, digital assets are considered a property, which means that the digital assets currently falls outside the scope of wash sale rule, which typically applies to stocks and securities. Basically, the wash sale rule disallows claiming a tax deduction on losses from selling and then repurchasing identical stocks or securities within a 30 days window. Because digital assets are not explicitly covered by this rule, investor can sell digital assets at a loss and immediately repurchase similar or identical assets without restriction, thereby creating a unique opportunity to harvest tax losses. This realized loss can be used to offset other capital gains or reduce taxable income by up to $3,000 per year for ordinary income. It is worth noting that it is essential to stay updated, as a proposal to extend the wash sale rule to include digital assets have been introduced but not yet passed. Further changes may impact the applicability of this strategy.
Looking forward, it is certain that digital assets regulation will continue to evolve as Congress and the IRS work to address the challenges of digital assets reporting. Here we have a few areas where we expect significant developments in the future.
First is reporting requirements. We may see mandatory reporting for every incidence of buying, selling, or exchanging digital assets, with more emphasis on capital gains tracking and classifying different types of digital asset transaction based on their tax treatment. Second is transparency. To prevent any potential misuse and criminal tax evasions, there's a strong push for greater transparency in digital assets trading. This could mean that exchanges and platforms will face stricter regulations, requiring them to report transaction details such as digital asset types, ownership, value, discoverability, storage format, and personal information such as social security number and taxpayer identification number directly to IRS. Third, bookkeeping softwares. The IRS may standardize the types of document to report that dealers and exchanges must provide to investors. And we recommend taxpayers use software such as CoinTracker, Legible, Cryptio, or Coinly to connect to the digital wallet exchanges. In conclusion, while the digital asset reporting is still developing, it's essential for all taxpayers to be involved in the digital asset to prepare for future requirements. And as always, accurate detailed bookkeeping will be key, and we strongly encourage you to keep account statements and transaction records from all digital asset dealers. Being proactive now will ensure a smoother tax filing experience in your following year. Thank you for your attention, and we are here to answer any questions and guide you through the changes so you can remain compliant and maximize your tax saving strategies.